Joining us right now is Karyn Cavanaugh. She is Senior Market Strategist of Voya Investment Management, and Hans Olsen, who is the Global Head of Investment Strategy at Stifel. And Hans, let's start with you since you're here on set with us. What do you think? Did you miss your opportunity to jump in and get a discount on stocks if you didn't buy last week?
No, I think you're going to get a couple of chances to buy the dips over the course of the year. And it's going to be a function of the economy essentially achieving escape velocity and the market's trying to reprice, an environment where there's a bit more inflation and interest rates get a chance to normalize. So
suddenly we look at other places, like maybe there are other places to put your money.
Precisely. You've got options now. Yeah.
And when you say you think we're going to be getting chances, I mean, we saw a correction of a full 10% pullback and then some.
Yeah.
You think there will be more correction type of?
I do. It would not surprise me in a year like this, where we are looking at interest rate normalization, for you to have several instances of 8 or 9% types of pullbacks over the course of the year. We saw that. I keep banging on about 1994, which was a year that was a pivotal year just like this, where you went from interest rate assistance on the part of the central bank to more normalized. And over the course of that year, you had about three instances of peak to trough pullbacks of about 8 or 9%.
Karyn, you agree with that?
Absolutely. I think we will see some choppiness, but I think investors have to realize that this backdrop of good economic earnings, good economic growth that's been unleashed by the tax cuts and less regulations, that's a great thing. We haven't been able to say this in decades, where the market and the economy are both ripping ahead. And so the investors need to get into the market and just ignore a little bit of choppiness. That's normal. That's what's going to happen.
But what Hans had pointed out is people are trying
to
reassess things and figure out where market valuation should be. If suddenly it looks like you can get a little more for your money if you put it in the bond market, you would still say that stocks are the best place to be?
17 times earnings, the bond yields are still below 3%. I still think bonds are, of course, an important part of a portfolio, but why wouldn't you want to be in stocks when we see that earnings are continuing to accelerate and we're going to see even more growth going forward? People are worried about this a deficit, 1.5 trillion because of the tax cuts. We're going to see economic growth, and that's different than what we've seen in the last decade. We're actually going to see some growth.
I mean, so that's the bullish case. I guess many of the traders and investors that I talk to are looking for when that turn is going to be. So this idea that it becomes less of a buy the dip type situation where you can buy on discounts, and it becomes a sell the rally situation where every time there's a little bit of strength, it's an opportunity for you to lighten up on. I guess the big question for a lot of people out there is whether or not they see signs that this could be a change in regime with regard to whether or not the stock market is still constructive. And that's the reason why, for a lot of people out there, I'm not sure how Karyn and Hans feel about this, but is it still constructive overall to own stocks?
I think so. I'm looking at this period as more of a portfolio construction issue rather than a market timing issue, in the sense that this is the time when you are, you're shortening the durations of the portfolio if you haven't done it already. You should have done it already. Number one. Number two, you're making sort of the pivot to more late cycle type of investing.
Such as?
Well, the financials, the energy stocks, consumer discretionary. These are the things that you would normally think about as the economy accelerates in the latter part of the business cycle.
But if you are expecting at least maybe 3 pullbacks, you said, of 8 to 9%, maybe even more, why not try? Why not try and market time it?
Well, you could, right? But which one do you play? And so, I tend to look at this, if the valuations are good, we've got earnings moving in the right way, it gives you a great opportunity to sort of start to reposition the portfolio, once we get these snapbacks as we've had this week, and you're acting more from a position of strength rather than reacting.
Karyn, how about you? Which places within the market do you think are the best places to try and focus your attentions and your money?
Well, I agree somewhat with Hans, but I don't think that shortening the duration of the portfolio, I know that bonds are going to get hit as interest rates go up, but think about your long treasuries, and those are really your risk control, and those are there when you need them. But I would agree, financials, I think energy has been beaten up. I like consumer discretionary, but I also continue to like tech because we're still in a low growth environment. So if you take a look at tech, we still see earnings that are growing at double digits, so that's a good place to be. But of course, areas where they have been beaten up. Everybody is worried about REITs. They have been beaten up, and they're the only ones that are negative year to date. But we're going to see interest rates rise, but it's not going to continue to rise at such a rapid pace. We are seeing economic growth, and that's a good thing, and we want higher interest rates. But I would say that overall, investors should be diversified across sectors, and also take a look at mid caps and small caps because they're going to be the biggest beneficiaries of these tax cuts and lower regulations.
All right, Karyn, thank you. Hans, thank you. It's good to see you both. And Dom, good to see you.
Thanks.
Hey there, thanks for checking out CNBC on YouTube. Be sure to subscribe to stay up to date on all of the day's biggest stories. You can also click on any of the videos around me to watch the latest from CNBC. Thanks for watching.